Hello and welcome to this Sunday, May 26th, 2024 edition of the weekly market recap. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'll be with you here for the next half hour or so as we talk about things happened last week, things that might happen in the week ahead, and basically just get a quick overview of what's going on in the market. Last week was kind of interesting. We had a couple of things that might have taken the market down, or at least maybe temporarily, but market came roaring back. First off, on Monday, we had JP Morgan CEO Jamie Dimon indicating that he wasn't quite sure how long he was going to be working. You know, he's always talked about his 5-year plan, and what his comment was this past week is that it isn't 5 years anymore. So the market was speculating as to when he might retire. Of course, there was no conclusion. So we don't know if it's 4.5 years or maybe it's a year and a half. Maybe it's next week. We don't know. So market doesn't like uncertainty. And all they can think about right now is that JP Morgan isn't going to have a CEO at some point down the road, and they're going to have to replace Jamie Dimon. And so JP Morgan on Monday in the afternoon sold off from about $204 to $195. I told our members at Earnings Beats I thought it was an opportunity, that JP Morgan is obviously a financial institution that stood the test of time. It's one of the best financial institutions out there, and it was on sale. Dropped about 5% in just a few hours, and the stock did come back up by the end of the week and finish back up above 200. But those types of announcements tend to be opportunities in the short term, and I think this one was as well. Speaking of opportunities, on Wednesday at 2 o'clock in the afternoon, the Fed, their minutes were released from the last FOMC meeting, and got shocking headline. They're worried about inflation. That was the big headline coming from the meeting, or from the minutes of the meeting. And the market sold off like it was new news. It was a big sell-off in the afternoon on Wednesday. And I was just kind of joking when I did the show. I think it was when I did my Trading Places live show on Thursday, that, you can't make this stuff up. I mean, the Fed has been waffling and been wavering, and, they talk about transparency. And if you can figure out how transparent they are, I mean, the only thing I see from the Fed is that they waffle. That's the transparent part. You don't know whether they're dovish. You don't know if they're hawkish. All you know is that from week to week, it's likely to change. And so anyway, the minutes came out and they're worried about inflation. That was the big news. Well, that's been going on for about 3 years now. I don't really think that's big news. But anyhow, that was plastered all over the news on Wednesday afternoon. The market sold off as a result. And then Wednesday evening, or at late afternoon, we had NVIDIA's earnings come out, absolutely blowing the doors off of earnings and revenue estimates. Stock gapped up hugely, traded above 1,000 for the first time. I think closed out the week somewhere around 1,060, 1,070. Really nice week for NVIDIA and many of the semiconductors. The Dow Jones US Semiconductor Index broke out and closed at an all-time high. So it was really good there. But I will say last week was a bifurcated week. It was not everything going up. In fact, it was mostly technology going up. And within technology, it was mostly semiconductors. So that's a really big area of the market. It held the market, it carried the market really in 2023. And last week, it carried the market again because the NASDAQ finished higher. And really the only reason was because of that strong semiconductor group. Dow was down. I mean, the Dow, after hitting 40,000, I think a week ago Friday, was back down to 39,000 by the end of last week. Dropping more than 2%, while the NASDAQ was up 1%. So it was this bifurcated market that we really dealt with last week. Let's go ahead and take a look at the action from last week and what happened. What I have for you first, we're going to look at candle glance charts. This is a way we can look at 12 charts simultaneously. I broke them down. I actually set them up in 5-year weekly formats. And I'm going to zero in so that we can take a little bit closer look at what happened last week. But here is the Dow Jones. Dow Jones for the week down 934 points, which was down more than 2%, as I mentioned. Got up to 40,000, came back down, hit the 20-day moving average, went right back, or excuse me, 20-week moving average, went right back up to the highs, set a new high, and then back down 900 points last week, a little over 900 points. But still, overall, in an uptrend. And one of the reasons why I pulled up the 5-year chart, we concentrate so much on the daily chart and what happened last week or the week before, and it's good to step back. In fact, when I do my weekly market report for members at Earnings Beats, one chart that I put in there every single week is the 100-year monthly chart of the S&P 500, so that we never lose focus on the big picture. The stock market goes down, or excuse me, goes up a whole lot more than it goes down. And that is clearly reflected when you use some perspective and you step back. This is stepping back, but not quite all the way back. But anyhow, this is a 5-year weekly chart. You can see that since the pandemic lows, we've been mostly higher. We had the 2022 cyclical bear market, but other than that, we've been pretty much steadily moving higher. And that continues even though we did have a rough week last week in the Dow. S&P 500 essentially flat for the week. So we got the NASDAQ up 1%. We got the Dow down more than 2%. S&P was flat. You can see up 0.03%. Not really much movement there. NASDAQ 100, there it is, rising 1.4%, breaking out to yet another new all-time high, closing at 18,808 on the week. And that was above the earlier highs that we had seen, probably closer to about 18.5 or something like that. I don't remember exactly what it was earlier in May, but we did clear it last week. Moving on to the mid caps, dropping 1.3%. Got back up close to a double top, recent double top, but we did pull back and still trying to hang on, which we've been doing successfully so far, hanging on to that 20-week EMA, which is rising and is above the rising 50-week SMA. IWM, Russell 2000 down 1.27%. So also falling back along with the Dow and along with the mid caps. Nothing horrible, still above that rising 20-week moving average. So I still think technicals look fine here, but the underperformance relative to the NASDAQ does continue. Transports. What's interesting looking at transports is that when I look at it daily on a daily chart, they look so absolutely horrible, especially when you see the market going up, the Dow hitting an all-time high a week ago Friday, and the transport's not able to do the same. But when you look at a longer-term chart, you can at least see that the transports are trending up. Sometimes you get that indication. I talk about the fact that we're trending lower. Well, that is definitely not the case when we look at this weekly chart. In fact, I see rising lows, mostly equal highs, maybe slightly lower of late, but we need to see a push back up above about the 17.5 level, and we're sitting at 15,000. So we got a long ways to go to get there. That would be roughly, about another 16, 17% to get back to the highs that we saw. This would have been highs back in 2021. So still got a lot of work to do. And when you look at where the Dow is, it doesn't exactly look good from a Dow theory standpoint. That's Dow theory goes back many, many years. Most of you probably are aware. But when you get a breakout in the Dow Jones Industrial Average, to confirm it, you want to see a breakout in the Dow Transports. And we have not seen that. Again, we haven't hit a high since back in 2021. The Dow, just a week ago, hit its all-time high, closing above 40,000 for the first time ever. And here we are with the, like I said, the transports about 16, 17% below breaking out to new all-time highs. So still got a lot of work to do there, and we'll continue to watch it. But I would say the transports are one of the areas in the market right now that still are somewhat bearish, or at least cautious. XLK, technology. Here was your leader last week, without a doubt. Technology gaining more than 1.5%, almost all of it due to the very, very strong semiconductor area. And we'll look at the semiconductors in just a bit. Communication services also did finish higher last week. So we had that group rising 0.41%. Beautiful uptrend still in play, holding above the 20-week EMA. Same thing for the XLK, by the way. We've had a couple of slight breaches of that 20-week EMA, but for the most part, we're trending above it, which in turn, the 20-week is trending above the 50. That's an uptrend. That's what an uptrend looks like. Moving over to the industrials. Industrials really strengthened in 2024, maybe late 2023 and into 2024, but beautiful move to the upside. We were down last week, though, 0.67%. So we'll see what happens, going forward as we move throughout the rest of or going into summer and throughout the summer. My guess is that we move higher over the summer. I don't think we're going to see huge increases. I've said before, I think, 5,500 is certainly possible in my view by sometime in July, early August. That's kind of what I'm thinking. Outside chance at maybe 56, 5,700. I don't know that we'll get there. We do tend to slow down once we get to mid-July. So we really we have less than 2 months to get there. And I'm just not thinking June is going to be that month where we're going to be, ripping to the upside. Again, I think it'll be a slow and steady kind of gain with some pullbacks along the way. That's what I'm expecting. And that's what I'd expect here from the XLI. Moving on. Now, originally I had the DWCREE, which is the Dow Jones Renewable Energy Index. But that index really caters to First Solar, and First Solar had a huge week. So the Renewable Energy Index actually went up by 40% last week because First Solar went up 40%. Wasn't exactly true of the whole group, because we had other areas or other stocks in the group that did not go up, or if they did go up, they went up a lot less than 40%. So instead of putting the DWCREE up here, I put in TAN, which is the Invesco Solar ETF. So we're still looking at a lot of those renewable energy stocks, but it's not so heavily weighted toward First Solar. And when we look at this, first of all, First Solar, and if you look at the DWCREE, I mean, they're going straight up. They're breaking out the new highs. This is a little bit more representative of what we've seen in renewable energy over the course of the last few years, with the TAN steadily declining. I will say, though, we came back up and closed above the declining 20-week moving average last week. And that's nothing different. I mean, we saw that back at the beginning of the year as well. I think that was, beginning of 2024. So we did it once before, but this time we're doing it with really heavy volume. Saw that volume pick up. It was the heaviest volume we've seen in 2024 for the week. Like I said, First Solar took off, but we also had other stocks. And Enphase Energy closed on a daily basis at its highest level in a few months, I think. Maybe several months. I don't remember exactly how far it goes back. But anyway, there was other strength, but it wasn't, I think in the TAN, First Solar, I think is 12% of the TAN. Enphase Energy, I believe, is 9%. Next Tracker, I think 7%. And then Solar Edge, SEDG, I think it's like 5%. So those are the four biggest holdings, but it's not all about First Solar. So it gives you a little bit better representation of the entire group. But this is a group that is kept putting in lower lows here. You can see that PPO had started to turn. So this weekly, we've got a positive divergence here. A breakout above the 50-week moving average could be really bullish for this group. And ultimately, you can see right around 56 was a support earlier if we go back a few years. And then where did our rally end back at the beginning of the year? Right at about that 55, 56 area. So if you get through the 50-week moving average and then can clear that resistance level, this is a group that potentially could be starting a big move. And the only reason I mention it is when it gets going, you don't want to wait a few weeks, because you could lose. You can see how fast, or hopefully you saw how fast First Solar went up this past week. I mean, it was up 40% on the week. This group tends to move just as fast, if not faster, than semiconductors when they get going. It's a little too early to say that they've gotten going, but they are at least improving. And so that's why I wanted to mention this group. Very strong last week and definitely on the improve. Semiconductors, well, with NVIDIA's report out, it was going nowhere but up, and that's exactly where it went, moving back to an all-time high. Semiconductors had pulled back pretty sharply in April when the overall market pulled back, but they have already moved all the way back up and cleared, easily cleared their all-time high, setting new records now just about every day. Heavy construction. This was a group that a week ago, I went in my weekly market report that I send out to members. I always point out the top 10 industry groups in the prior week, and then the bottom 10, just to give a recap in my weekly market recap weekly market recap that goes out to members. And DJ USHV was one of the 10 that were on the weakest, not last week, but the week before. And I pointed it out saying that the other industries that were on that bottom 10 list were mostly areas that were trending lower. This was an exception. Heavy construction has been one of the stronger areas, but it had just pulled back for a week. And so I thought that that might be an opportunity. And you can see the group bounced back and was one of the top performing groups again last week. So when you get strong groups that pull back, maybe for a week, maybe for a couple weeks, they tend to be great opportunities to get in and then try to ride some of the stocks within that group. And I always look for leaders. I want to find stocks that are leading the heavy construction group to the upside. So if I can find leading stocks and leading industry groups that have pulled back, for me, that's pretty good trading opportunity. That's what I look for. All right, let's move on. 10-year Treasury yield. So what happened here last week? Well, I mean, you can see we actually went up for the week. We were up about 5 basis points. So we were up from 4.41 to slightly above 4.465, 4.467 actually. So roughly about 5 basis points. Actually, it was 4.42 to roughly 4.47. So rising 5 basis points, that's probably one of the reasons why we saw small caps underperforming again last week. We did get that little bit of a pop in the interest rates. But if you look at this, I mean, I think the definition for me, looking longer term, is are we above the rising 20-week moving average, which is above the rising 50-week moving average? And in this case, the answer is yes. So I would say that currently that we remain in a longer-term uptrend in the 10-year Treasury yield. And I think for the small caps to really begin to turn and really move with some gusto to the upside, I'm believing that's probably going to have to change. And so I don't know when it changes. I do think it's going to change. I don't think the 10-year Treasury yield's going back down to 2%. But I think it could go to 3.5 to 4. I mean, maybe 3, but for now, I would say 3.5 to 4 would be a good level on the 10-year Treasury yield eventually. And when that happens, or as it happens, as it's starting to break down, I think that's when we'll start to see more money rotate over into that small cap area. All right, technology. So here is the 5-year weekly chart on technology. Just wanted to point out that as it pulled back, got down to about the 20-week moving average, went slightly below it, came roaring right back. 5 straight weeks now that we have seen gains in technology. The relative strength line turning back up, which is nice. If you look back over the last 5 years, you'll see XLK has consistently been putting in higher highs and higher lows. It's not always perfect. And in 2022, when we had this cyclical bear market, you can see technology was hit a little bit harder than the overall S&P 500, which makes sense. When the market is weakening, usually you see defensive stocks outperform and aggressive stocks underperform, and that's exactly what we saw in 2022. Occasionally, even during good markets, you can go back into 2020 and 2021. Remember, this part of 2021 is when we were first getting those explosive readings in inflation to the upside. And so growth stocks like technology got hit, even though the market went up. Well, the reason the market went up is because some of the value-oriented areas of the market had been so beaten up and so forgotten that when we finally saw a little bit of weakness in technology and some of the aggressive names, that money rotated. It didn't leave the market, it rotated. And as a result, the S&P was able to go higher, even though we were seeing a period of lower lows and lower highs on technology. Then eventually technology comes right back through, starts moving up again. And then we got the cyclical bear market. And then starting in 2023, technology exploded to the upside. And of course, that led to a big explosion higher in the S&P. Now, S&P 500 moving up again, breaking out. Growth, not so much. Why? Well, we've seen some of the other more value-oriented areas carrying the market while we pulled back in some of the aggressive groups. But that is starting to flip again, and we're starting to see more and more money rotating into more growth areas. And that's what I talked about at the beginning of May. That's one of the myths about the go away in May theory, is that May through August tends to be a very, very strong period, the best period, the period when growth outperforms value by the most. It's May through August. And so we got into May, and it's been a straight up line so far in May, technology relative to the S&P 500. And as I mentioned, 5 straight weeks of gains now on the XLK. Now, within the XLK, within technology, we know semiconductors had a great week. So the question a lot of times is, okay, well, this group is showing leadership. What do I do with that? Because I can't invest in the semiconductor index. The index is just a combination of a lot of its component stocks. But there are ETFs that track various semiconductors in various ways. Not all ETFs are the same. Some ETFs will hold different stocks and different percentages of those stocks. So you have to be careful. But what I like to do is I like to look at the individual stocks. And so at Earnings Beats, one thing that we do is we keep chart lists. That's one of the huge benefits of being a member at Earnings Beats, is that we do a lot of homework for our members, and we organize chart lists that they can then use, that are available right at their fingertips. All they have to do is download the chart lists. It takes, some of the chart lists takes 5 seconds, others maybe 15, 20 seconds. But you can go through all of our chart lists, have them all downloaded in probably a couple of minutes. And then all of the research we do, which encompasses hundreds of hours, literally goes to our members in about 2 minutes via these chart lists. So this particular chart list is the raised guidance chart list. So what we do is we go back throughout earnings season, and as companies are reporting, we find out which companies are raising guidance. And if they're raising their revenue guidance and or their earnings guidance, they will typically find their way onto this chart or into this chart list. The ones that wouldn't would be stocks that are illiquid, stocks that trade under $5. I usually don't look at those. But that's really the only couple of things that normally would filter a stock out if it did if it did raise its guidance. Anyhow, what you can do is when you pull up these chart lists in summary style, I mean, we can pull them up in lots of different ways, but if we pull them up in summary style, it looks like this. And what I've done is I've sorted by scooter, and that's the stock chart's technical rank. It gives us the relative strength of what's going on. This stock relative to other stocks in its same asset class. So anything with a high scooter rank, like in the 90s, 100s, the highest you can go. Actually, 99.9 is the highest you can go, and 0.1 is the lowest. And so by sorting it in scooter order, it gives us a little sense of relative strength. Okay. So I go to the raised guidance. I have the stocks in scooter order, which is relative strength. The only thing I need to do is go to the search table and type in semiconductors. And it brings up all of the semiconductors that have raised guidance, and it's listed in scooter order. Now I can tell you NVIDIA, which is number 1 on this list, is in our portfolios that we announced back on May 19th, May 18th. NVIDIA is in there. Qualcomm is in there. So the top two on the raised guidance and scooter reports are on there. So we benefited by both of these gains last week in our portfolios. NVIDIA going up 15% and Qualcomm going up 8.5%. But this is a way that you can quickly look to see relative strength within a group that maybe is breaking out, or maybe it's a group that's pulled back. And, you know, it's come back to its 20-day moving average, and you want to see which are the best stocks. If this is a group you like and you love this 20-day test, which stocks are the strongest in this group? Well, you do the same thing. Now, a number of software companies are going to be reporting this week, and mostly second tier. I know Salesforce.com is reporting. I think Viva, Okta, some of these types of names will be reporting. And if you pull up software, you can also look at the highest scooter scores. Some of them may be reporting this week. But when I pull this up, I can tell you APP is in our portfolios. It was down 0.4% last week, which wasn't bad considering that software just hasn't been performing well. CrowdStrike is in our list, or is in our portfolio. It gained 1.6% last week. But again, this is where we're going to find most of the stocks that we like to trade or that we want to hold in a portfolio, because they do have the relative strength. They are showing leadership in what typically is a really good area of the market during a secular bull market. Software, along with semiconductors and probably internet, would be the three groups that I would focus strongly on when we've got a secular bull market advance. Those are the three groups that tend to lead. And there are others. Some of the retail groups, broadline retail, specialty retail, also can lead during the secular bull market advances. Autos, if Tesla would ever get going and sustain a move, you'll see autos perform better. And then there are, you know, a handful of others as well. But these are some of the big ones that I look at. So looking at the semiconductors, one thing I wanted to point out, and I've pointed this out to members, and I think to the general public as well. When you look at the months within a quarter, the first and second months tend to perform better than the third month of a quarter. And I mention that because June is coming up, which is the third month of the second quarter. If you go across here and look at semiconductors, it's very unique and maybe something you don't realize about semiconductors. But over the last 20 years, if you add up their average returns in January, April, July, and October, that's the first month out of every quarter, calendar quarter, semiconductors lose an average of 1.3%. If you add up the second months of every calendar quarter, February, May, August, November, semiconductors, and this is relative to the S&P, I should say. So semiconductors go up in the first month, but they go up 1.3 percentage point less than the S&P 500 on average. If we look at the second month, however, semiconductors outperform the S&P 500 over those 4 months that I just showed you, February, May, and I'll bring this up here so you can see. February 2.8, May 3.3, August 0.2, November 2.4. This is the average outperformance above and beyond the S&P 500. So this doesn't mean that semiconductors go up an average of 2.8% in February and 3.3 in May. It means it outperforms the S&P by those levels. So if you add them across those 4 months, semiconductors average outperforming the S&P 500 by 8.7 percentage points, February, May, August, November. Knowing that, it would have been pretty easy, or at least easier, to have been in maybe overly weighted semiconductors this month when it absolutely exploded. Semiconductors have exploded during the month of May. Look at across here. What is the highest number? What's the best month for semiconductors? Well, over the last 20 years, they've outperformed the S&P 500 by 70% of May's. So over the last 20 years, that's going to be 14 years out of 20. And they've averaged outperforming by 3.3% during the month of May. Another reason why you don't want to go away in May. It's the best month of the year for semiconductors. Now, on a relative basis. Now, if we get rid of the this and we just say, hey, just give me the numbers on the semiconductors. This is over the last 5 years. Look at May and November, last 5 years, all of them up. But let's go back 20 years. There's May, 3.7%, and there's November, 4.4%. So in terms of absolute value or just absolute price action, November is the best month. But if we're looking relative to the S&P, May is the best month. But clearly, those are your 2 months for semiconductors, and they're both second months in a calendar quarter. Anyway, and we do a seasonality. We do a lot of seasonality work for our members. Talked about the chart list for our members. I do want to mention to everyone that we have our spring special going right now at Earnings Beats. So if you go to our website, earningsbeats.com, and click on this link, it will give you a lot of information about what we do and what you're going to get as a member. And then if you go all the way to the bottom, you'll see the specials that we're offering right now. This lasts until June 2nd. So you got a little over a week to go, or actually a week to go. It's going to be a week ago, or it's going to be a week next Sunday. Sorry, next Sunday at midnight, the deal is going to end. But you can buy 1 year of our service, get 2 months free. You can buy 2 years of our service, get 6 months free, or buy 3 years of our service, get 12 months free, a full year free by signing up for 3 years. And by the way, you still get your trial, you still get your 30-day trial. And that's also one way to join, is just sign up first for your no-cost trial. Check us out for the next week and then decide if you want to commit. But great time of the year. This is absolutely the best price you will get at any point during the calendar year on our service. So now's the time to check us out, even if it's just a no-cost 30-day trial. Moving on. So we had the good, which was technology. Now let's look at the bad, which was energy. Energy did not have a good week last week, dropping 3.77% on the week. It's mostly been going sideways, but rather than look at the absolute price chart, let's look at the relative price chart. I want you to you should find this pretty interesting. We were going down. Energy versus the S&P 500 was mostly downtrending. We got into the cyclical bear market in 2022, and energy took off. Why? Well, the big reason why is that there was a lot of money rotating out of aggressive areas of the market. Technology got clobbered. I showed you that group was underperforming the S&P. The S&P went down 28%. So if you're underperforming that, you're not doing very well. XLK was underperforming during that bear market, cyclical bear market. So was communication services, discretionary, financials, industrials, not as much, but they too were underperforming. And so as a result, there was a lot of proceeds out there, a lot of money from all the selling. Energy got its fair share. So it was a downtrending group. And all of a sudden look at this, the June low where I called the bottom back in 2022, energy peaked. And then when we went down one more time in the market, we went down a little bit below that June low in October. And look at October's high. That was a new high for energy relative to the S&P. So here, energy did really well while the market stunk. But once we bottomed in October and we started moving up, look at the relative weakness that we've seen now in energy. We're putting in lower lows and lower highs. I mean, I don't know about you, but I see a downtrend for now the last 18 months or so. So yeah, on an absolute basis, we've seen energy break out and pull back to a breakout level. I mean, right around that 91 level. Here was a high at 90. Here was a high at about 91 or 92. Here was the breakout through that level, and now we're coming back down testing it. So on the absolute chart, it doesn't look that bad for energy, but 18 months now we've been downtrending relative to the S&P 500. Folks, it's not whether or not you go up. It's whether or not you're going up versus the S&P 500. If you're not outperforming the S&P 500, then you're losing ground. You should just be in the S&P. The other thing with energy is look at the crude oil prices. I mean, we topped up at about $120 per barrel in 2022. We went all the way back down into the 60s, rallied back into the 90s, pulled back into the 60s, back up near 90. And now we're just sitting in the middle. We closed last week at $77 a barrel. Energy prices aren't really going anywhere. So that also is kind of limiting upside in some of the energy stocks. I mean, 2022, when energy was outperforming, those first 5 or 6 months, that's when energy went from 80 to 120, actually above 130 in March of 2022. So it was a combination of money rotating out of other areas, plus the benefit of crude oil prices going up. All right, got to look, of course, at the core CPI. We like to take a look at that. And the Fed is worried about inflation. Wow, that's so nice, because we've actually been going down on the core CPI now on an annual basis since probably about September of 2022. So we're now working on 2 years where we've gone down almost unabatedly, just straight down in inflation. And usually what happens is when that happens, the stock market explodes, which, by the way, the stock market has exploded since 2022. I said it when inflation was topping, that inflation's going to roll over, and when it does, stock market's going to explode. And that's what happens. I mean, go back to the 1970s when we finally started to top, in the early 1980s in inflation, the annual rate started to drop. What happened? 80s through all the way to the 2000s, when inflation just kept going lower and lower, what'd the market do? Market just kept going higher and higher. Inflation eats away at future earnings. When inflation comes down, those future earnings are, investable. You're going to get all of it. It's not going to be eaten into by inflation. So as inflation comes down, those future earnings look better and better, causing valuations to go up. Don't hear this stuff on CNBC because they don't want you to be smart. They don't want you to be educated. They want you to listen to them. They're the experts. Yep. And the Fed's the expert too. They're now worried about inflation. That's really laughable. All right, I'm going to talk about gold. And I get comments that, why do I keep talking about gold? I keep talking about gold because I don't think people get it. It's that simple. I have not said gold isn't going higher. I have said gold isn't going higher relative to the S&P 500. Gold is broken out, and it's 2334. I think over the next few years, gold could hit 3,000. I'm not one of those think it's going to 4,000, 5,000, 20,000. That, you have to listen to Peter Schiff for that. He'll sell you a bill of goods on that one. 20,000 on gold is what I think. Last thing I heard. Crazy. Maybe eventually, maybe in the year, I don't know, 2200. Maybe we'll hit 20,000 in year 2200. Maybe it'll be in year 2080. I don't know when it's going to be. It's going to be way down the road. Anyhow, looking at gold, yes, we broke out. I am not saying we haven't broken out. I'm not even saying that doesn't look good on an absolute price chart. Energy broke out. Energy broke about above 91. Went up to 98, 99, then pulled back, back to that 91 level. The key with gold is that it doesn't go up relative to the S&P 500 unless one of two things are present. You need one of two or both things to be present for gold to be where you want to put your money, where it is actually outperforming the S&P 500. One is a falling dollar. If you get the dollar trending lower, that is an automatic tailwind for gold. That's number one. Number two is volatility. You need the stock market to be getting clobbered. That's when money rotates out of the stock market, goes into gold. So, and that's when the volatility index spikes. Look at the chart. I mean, I'm going to pull this up. Let's look at the most recent data, because this is what everybody wants to talk about right now. Gold breaking out. Gold looks great. Oh my gosh, look at this long-term consolidation. It's broken out. It's going to go higher. You know what? I don't necessarily disagree. I think gold could go higher. I think gold could go to, I don't know, maybe on this run, maybe it goes to 25, 26, 2,700 over the summer, or maybe into year end. But it's going to underperform the stock market, in my opinion, the S&P 500. And that is where this next panel goes. So remember this, we're breaking out on the absolute price chart. That's great. Wonderful. You see a relative breakout? I mean, I don't. I see tops going back. I mean, we're going back to the last 2.5 years. We've had relative price gold, the gold index versus the S&P 500 index. We've been above 0.5. Right now, we're at 0.44. So my point isn't that gold can't go higher. It's that it's not going to go higher relative to the S&P 500. And even with this breakout, it's still proven it's not breaking out relative to the S&P. So I just ask you a simple question. If gold goes up 10%, the S&P 500 goes up 20%, how excited are you going to be about owning gold? If you really love the fact that it's going up 10% while the S&P is going up 20, feel free to jump in. That's my point about gold. It has nothing to do about whether gold's going up or down. It's about its relative performance, and it's not going to outperform the S&P 500, in my opinion, for an extended period of time until we move into a secular bear market, which, good news, I think we'll probably be in maybe in about 7 to 10 years from now. So that's all I have to say on gold. There was that renewable energy. I told you that DW CRE was breaking out. I mean, how good does that look over the last 5 years? That looks a whole lot better than that TAN ETF that I brought up, right? And if we look at First Solar, there's First Solar breaking out. Again, if you just look at the CRE, DW CRE, or you look at First Solar, you think, hey, renewable energy is on fire. It's not on fire. These two are on fire, mostly because the DW CRE tracks, in essence, the First Solar stock price. So that big move right there is why we saw First Solar last week up 40%, and DW CRE up last week up 40%. I mean, it's like hand in hand. And then finally, there is the TAN. I wanted to show you that breakout there above that 20-week moving average. Last time we saw that back in December, you can see that the volume was very light. Here we're doing it, the volume is very heavy. So that's one difference. We do have overhead resistance, I'm going to say between about 55 and 60 on TAN. But we are, I'll bring up Enphase. Enphase Energy also last week making a break above its 50-week moving average. First time since back in the end of 2022, early 2023. First time, and we're doing it moving up with volume increasing. So just want to point that out again. I don't know if we're quite ready to make a run in the renewable energy space, but when it runs, look back. I mean, this is Enphase Energy. You can see how fast this stock ran from probably $25 to $250 in about 10 months. And so when the stocks do move, they can really move. Anyhow, that's all I've got for this week's weekly market recap. I would love to have you click the like button below, maybe subscribe to our channel. That would certainly help us as we continue to try to grow our YouTube channel. So please do that for us if you will. But other than that, that's it. Have a great week upcoming. And it is a holiday shortened week upcoming, of course, with Memorial Day on Monday. So we've got a shortened week, and it is the last week in May, heading into the first week in June, which historically does tend to be a bullish period. We'll see if we can extend the gains we saw on Friday. Have a great day. Have a great week, everybody. Happy trading.